Yeah, oil is a very interesting thing to talk about because really from January until today, it really has not followed fundamentals very closely. It's really been a lot more about sentiment. And so it's really hard because, like, we're in this stage of oversupply earlier in the year, but the market wouldn't rally. Then finally it did. We saw a 20-point rally, and now it's the other way around where demand growth is still pretty good, a lot better than most people expected. We're seeing some draws, and so the market's just falling off just a little bit. And as you mentioned, this civil strife in Nigeria certainly not helping things. But if this would have happened a year ago, I think oil would probably be about $10 lower than it is today. So I think the bottom line is that it continues to follow sentiment and feelings of the market and a lot less with fundamentals.
Larry, what sort of impact would Brexit have on those oil markets? I mean, if we did see Britain remaining in the EU, would that certainly be positive for those oil markets? Would we see those prices rising?
It's very complicated to answer that because there's going to be a knee-jerk reaction to whatever happens. And, if they vote to leave the European Union, then obviously there's going to be a grab for risk or non-risk assets, risk-adverse assets, as it were. And so the commodity complex in general would go down, the dollar would rise, et cetera. And if they vote to stay, then perhaps we would go back to fundamentals just a little bit more, realizing that perhaps oil needs to continue to drift lower to that $45 a barrel point. That would make sense given the fundamentals underlying the market.
More broadly, around Brexit and sort of the market impact, how would that, because certainly there will be ramifications probably either way, particularly for the EU, but we heard those comments from Janet Yellen that it would have economic repercussions sort of around the world. What impact, if any, would it have on the US and the US economy?
I think for the US economy, the impact actually would be fairly small. I mean, the trade arrangements we have between the UK and US are actually fairly insignificant compared to some other countries. But even that said, I mean, I think a lot of the consequences of this are overblown and really not thought out. I mean, figure the fact that it's going to take 2 years to set this whole thing in place if they do decide to leave. And first they have to figure if it's legal to leave. And I think Parliament would have to vote on that. So I think the knee-jerk reaction might be one thing, but the intermediate term would be much different. People talk about growth. They talk about the pound going down. But when you consider that retail prices, inflation in the UK are about 1% a year, I can't imagine that clobbering the British pound as far down as people should say. I'm not saying that it doesn't have implications. I just think it's vastly overstated.
Yeah, all right. And of course, the impact on the dollar, I mean, that would certainly be felt around the globe, the FX market, then, of course, credit markets. And then thirdly, I suppose we'd get that reaction in equity markets. No doubt, if we were to see Britain leaving, then there would be this flight once again into those safe haven assets, the likes of, the yen and gold and so forth.
Yeah, exactly. We'd see gold, yen, U.S. dollar, perhaps even U.S. treasuries. But I do believe that's going to be a knee-jerk reaction because, again, it's not like they're just getting pushed off the pavement, and it's not Grexit. I mean, it's a country that has its own currency. It has its own monetary policy. It would take a long time to figure out how to unravel all this. And again, I'm not making light of it. I'm just saying that the knee-jerk reaction to whatever the decision is could be 100% incorrect.
Okay. All right. Let's move on to the Fed because, of course, that's also one of the upcoming catalysts as well. We've heard from Janet Yellen today, speaking before the Senate Banking Committee there. What did you make of her comments? Did she deviate too much from her press conference after the recent FOMC meeting?
No, she didn't. Her last press conference was a lot more dovish than I expected. It actually caught me very flat-footed. But because of that, today's meeting didn't surprise me at all. I mean, she's just basically making it front and center that, what happens in Europe with sovereign yields falling, with central bank easing in Europe is definitely going to affect the opinion of the FOMC here in the United States. So yeah, it just did not surprise me one iota, nor did it surprise the market.
Well, speaking of the market, I mean, we sort of are still trading around those high levels. Still concerns, I guess, about the underlying growth that's coming through, not only in the economy, but of course, earnings as well. I guess we have spoken about some of those upcoming catalysts, but take us through those catalysts sort of in the months going ahead and what's likely to be the key driver of the market.
Yeah, it's really hard to tell because, like, right now, it seems like the bullish and bearish narratives are equally balanced, and we're going back to the old May and June, late May, early June of gloom and doom sentiment that kind of drives the market. But yeah, we do have many catalysts, and we have to, other than Brexit, we need to consider China. It's not so much that they're going to, continually devalue the currency. It's basically the pace at which the currency is devalued that makes an enormous difference. Also, the U.S. elections. I mean, it's 5 months away from now. Right now, Hillary Clinton definitely is the leader, but we have many months to go. And the clarity around that will do a lot to either support or unhinge the markets. And also, we can't keep out of Japanese monetary policy, given what they did back in January. That was a huge, not mistake per se, but a surprise to the market. What are they going to do next? So I think all those things are enormous catalysts, and I'm actually overly impressed with how resilient our stock market has been, given the immense amount of catalysts that we have in front of us.